Friends, let's take the help of an example to understand how this entire non-integrated system of accounting works. So what we are going to do is we are going to take the help of an example and first prepare the cost sheet that we have been preparing regularly, and with the help of this cost sheet and the information that is given, we will try to update the books of accounts. Alright, in the process of updating the books of accounts, we will open several accounts such as the general ledger adjustment account or the cost ledger control account, the stores ledger control account, the wage control accounts, WIP control accounts, and so on and so forth, whatever is required in order to learn the non-integrated system of accounts. So let's look at the example. Let's say during a particular period, we have purchased raw material worth 1 lakh. Out of this 1 lakh, we have issued directly to production 80,000 and indirect material issued is worth 10,000. We still have a balance at the end of the period of 10,000 rupees. Let's say we have incurred wages and the total wage that we have paid is rupees 1 lakh, out of which 60,000 is towards direct wages, 20,000 is towards the production overheads, 15,000 towards admin and office overheads, and 5,000 towards selling and distribution overheads. Apart from this, let us say we have additionally incurred production overheads amounting to rupees 20,000, administration and overhead expenses amounting to rupees 35,000, and selling and distribution overheads amounting to rupees 15,000. Alright, let's say during the period we have absorbed production overheads to the extent of 45,000 and to the extent of 5,000 it has remained unabsorbed. Apart from this, the cost of the goods that we have produced, the finished goods produced was worth rupees 1,95,000, and out of this 1,95,000 worth of goods costing rupees 1,90,000 have been sold for rupees 2,50,000. So these are all the transactions that have taken place during the period. Now our objective is to first prepare a cost sheet which is going to summarize the entire transactions and help us understanding what is the profit or loss that we have made, and then we will try to reflect the cost sheet in the books of accounts so that it becomes understandable for everyone. So friends, let's start with the preparation of the cost sheet. Now in the cost sheet, the first thing that we do is we calculate the prime cost. Let us indicate the direct material. How much direct material we have issued to production? The material issued to production is 80,000. So direct material issued to production 80,000, add direct wages. Direct wages is rupees 60,000. So direct material plus direct wages, we have 1,40,000 prime cost. Now to this prime cost, we are going to add all our factory related overheads, all our works related overheads, or as we generally call it, all our production related overheads. Now here production related overheads, there are of two types. One, they have said there is some indirect material that we have issued to production. Second, they have said there is some indirect wages that we have used towards the production. And third, there is some production overheads which we have incurred directly. So if we add up all the three, the indirect material that we have used is 10,000, the indirect wages towards production is rupees 20,000, and the production overhead that we have incurred directly is rupees 20,000. So totally we are getting 10 plus 20 plus 20, 50,000, but they have very clearly said that out of this 50,000, we were able to absorb only rupees 45,000. So the production overheads absorbed is what we are going to take to our cost sheet, and we are going to say to the prime cost of 1,40,000, let us add the production overheads absorbed of rupees 45,000. So we get the cost of production as rupees 1,85,000. Now apart from this 1,85,000, they are also saying that there is some administration related expenditure which is in relation to the finished goods, which is in relation to the production. So let us now add 10,000 rupees of admin expenditure which was also related to the production activity. That will give us 1,85,000 plus 10,000, 1,95,000 as the cost of production. Now out of this cost of production, they are saying we have sold goods worth rupees 1,90,000. So to the cost of production, if we adjust for opening stock and closing stock, we are going to get the cost of goods sold. So let's do that. We have spent totally 1,95,000 towards the production activity, and they are saying out of this 1,95,000 we have sold goods worth only rupees 1,90,000. What happens to the balance 5,000? The balance 5,000 is going to be our closing stock. So let's indicate that in the cost sheet. So 1,95,000 cost of production, add opening stock 0, less closing stock 5,000, we get the cost of goods sold as rupees 1,90,000. Now to the cost of goods sold, we will add all our other admin and office overheads and selling and distribution overheads in order to arrive at cost of sales. Let's do that. So let's add admin overheads. Now what is the total admin overheads that we have incurred? One, they have said out of the direct wages, 15,000 is towards admin overhead. So we have that 15,000 plus we have specifically spent how much? 35,000. So we have total admin overheads of 50,000. Out of this total admin overheads of 50,000, we have already transferred to production how much? We have said production related is 10,000. So here we have a balancing figure of 40,000. So that 40,000 let us now add to our cost sheet. Again I am saying the 15,000 of indirect wages towards administration plus 35,000 spent directly, total 50,000 minus the 10,000 that we have already transferred to production. So balance admin and office overheads is 40,000. And lastly we have the selling and distribution expenses. We have incurred 15,000 specifically and 5,000 is wages that was incurred towards selling and distribution. So totally we have 15,000 plus 5,000, 20,000. So if we add 1,90,000 cost of goods sold plus 40,000 administration overheads, that is 2,30,000 plus 20,000 selling and distribution overheads, 2,50,000. So rupees 2,50,000 becomes our cost of sales. Now you have to be a little careful here. If I go back to my production overheads, we have spent totally 50,000, but we have absorbed how much? We have absorbed only 45,000. It is very clearly given that 5,000 rupees is the production overhead which is not absorbed or under absorbed. So we will now directly debit it to the cost sheet and we will adjust the cost of sales to arrive at the adjusted cost of sales. So 2,50,000 is the normal cost of sales plus this unabsorbed or under absorbed overhead of 5,000. The adjusted cost of sales is going to be rupees 2,55,000. Now against this 2,55,000, we have a sales revenue of rupees 3 lakhs. So if I balance it out, we get the profit as rupees 45,000. So this is the cost sheet. Now what we are going to do is very, very important. This same workflow we are going to represent in the books of accounts. We are going to represent it in the cost accounting records. So friends, let's simultaneously open ledger accounts for these accounts and start posting the entries as we go on understanding the transactions. So the first account that we are going to open is the stores ledger control account. Now on the debit side of this account, we are going to record for the material that has come in. So we will say to cost ledger control account debit 1 lakh. And if I open a cost ledger control account, in the cost control ledger account on the credit side, we are going to have the posting which will be by store ledger control account 1 lakh. So we have done the debit and the credit posting. Let us go to the second transaction. They are saying out of that 1 lakh, we have issued 80,000 worth of goods to the production activity. So let's pass an entry now for this 80,000 worth of goods issued to production. Now what will be the entry? First we will open another account, a third account which is going to be called as the work in progress control account. In this account we are going to debit all the expenditures that we have incurred in relation to the production. So we will now open one account and we will transfer the goods from the stores ledger control account to the WIP control account. Since the goods are moving out from the stores ledger control account, are we going to debit it or credit it? We are going to credit it. Debit what comes in, credit what goes out. So our entry is going to be WIP control account debit 80,000 to stores ledger control account 80,000 being the material issued for production. Let's quickly post this entries in our ledger accounts. Going back to the store ledger control account, we will have now on the credit side posting which will say by WIP control account 80,000, and in the WIP control account on the debit side we will have the posting to stores ledger control account 80,000. Now next, we have issued 10,000 worth of goods towards production activity which is indirect in nature. So what we will do is we will try to transfer the goods, the cost of the goods from the stores ledger control account to a new account which we are going to open, which is going to be called as the production overhead control account. So the entry for this will be what? Since goods are going out again, we are going to credit the stores ledger control account, and what are we going to debit? We are going to debit the production overhead control account. So our entry will be production overhead control account debit 10,000 to stores ledger control account 10,000. Let's quickly go back to our ledger accounts and do the posting of this journal entry as well. So in the stores ledger control account, we will have on the credit side by production overhead control account 10,000, and let's open a new account for the production overhead control account. In this account, on the debit side, we are going to have to stores ledger control account 10,000. We have made a payment of rupees 1 lakh towards the wages. So what we will do is we will record this transaction. The transaction will be recorded using the wage control account. So we will say wage control account debit 1 lakh to, generally it would have been cash, bank or payable, but here in cost records we don't maintain cash, bank, payable. What are we going to do? We are going to credit it to a representative account which is the cost ledger control account. So the entry will be wage control account debit 1 lakh to cost ledger control account 1 lakh. Let's do the entry posting. In the cost ledger control account, we have on the credit side by wage control account 1 lakh, and in the wage control account on the debit side we will write to cost ledger control account 1 lakh. Now what has happened? How have we used this wages? They are saying out of this 1 lakh rupee, 60,000 is direct towards production. Alright, so we need to transfer 60,000 directly to WIP account. They are saying 20,000 is towards the production related activity. So we will transfer 20,000 to the production overhead control account. 15,000 is towards administration. So we will transfer 15,000 to a new account which is going to be called as admin and office overheads control account, and the balance 5,000 they said it was towards selling and distribution. So we will open one more account for selling and distribution overheads control, and we will transfer 5,000 to that account. So what will be the entry? The entry will be, we will debit the respective control accounts for WIP, production, admin and selling, and we are going to credit the wage control account so that it becomes 0. So let's pass the entry. WIP control account debit how much? 60,000, because 60,000 is directly for production. Then production overhead control account debit rupees 20,000. Admin and office overhead control account debit rupees 15,000. Selling and distribution expense control account or selling and distribution overhead control account debit 5,000 to wage control account rupees 1 lakh. In the wage control account, on the credit side, you will have WIP control 60, production overhead control 20, admin and office overhead control account 15,000, selling and distribution overhead control account 5,000. And in the respective accounts, on the debit side, we are going to write to wage control account. In the WIP control account, we will get to wage control account 60,000. In the production overhead control account, we will get on the debit side to wage control account 20,000. In the admin and office overhead control account, on the debit side, we will get to wage control account 15,000. And in the selling and distribution overhead control account, we will get to wage control account 5,000. So this is how the entry will get passed and will get posted in the respective control accounts. So what we have done, we have very carefully recorded the expenditure and posted it in the respective control accounts. Now next, what they are saying we have, in addition to the items mentioned till now, incurred some production overheads of 20,000 directly. What will be the entry for this? We will debit the production overhead control account with 20,000 and credit the representative account, that is the cost ledger control account 20,000. Let's do the posting. In the cost ledger control account, on the credit side, we will have by production overhead control account 20,000, and in the production overhead control account, we will say to cost ledger control account 20,000. Now next, they have said we have absorbed 45,000 worth of production overheads. Let's see what is the treatment of this. If we go to our production overhead control account, on the debit side, we have a total debit of rupees 50,000. So the total production overheads that we have incurred is 50,000. They are saying out of this 50,000, we have absorbed worth rupees 45,000. So 45,000 rupees we are going to transfer from the production overhead control account to which account? To the WIP control account, because the production has to absorb this expenditure. So the entry for that will be WIP control account debit rupees 45,000 to production overhead control account rupees 45,000 being absorption of production overheads recorded. Let's go to the respective ledger accounts and do the posting. In the production overhead control account, on the credit side, we will say by WIP control account 45,000, and in the WIP control account, on the debit side, we will have to production overhead control account rupees 45,000. Alright, I am quickly going back to the production overhead control account. Now if we try to balance this account, on the debit side we have 50,000, but we have absorbed only 45,000 out of the total expenditure. Balance 5,000, they are saying it is unabsorbed. All items which are of exceptional nature, which are abnormal in nature, maybe abnormal gain or abnormal loss, maybe under recovery of overheads or over recovery of overheads, it has to be transferred directly to the costing P&L. So what we are going to do is we are going to transfer this 5,000 rupees directly to the costing P&L. What should be the entry for this? We have a debit balance in the production overhead control account. We need to nullify it, we need to reduce it, we need to make it zero. So we are going to credit this account and we are going to debit the costing P&L account. So the entry will be costing P&L account debit 5,000 to production overhead control account rupees 5,000. So with this, our production overhead control account gets nullified. Let's do the entry posting. In the production overhead control account, on the credit side, we will write by costing P&L 5,000 and close the account. And in the costing P&L, now we need to open a new statement, which is the costing P&L statement. On the debit side, we will have to production overhead control account rupees 5,000 being overheads under absorbed or unabsorbed. Alright, next. They are saying we have produced goods worth rupees 1,95,000 during the period. Now we have to pass an entry, we have to record the transaction of finished goods coming into existence. So what we will do, from WIP account, we are going to transfer it to the finished goods account. Let's first go to the WIP account. In the WIP account, what all do we have? Presently we have the direct material which got issued, we have the direct wages which got issued, we have the production overheads which have to be absorbed. Apart from this, they are saying there is some administration related overheads also which is related to the production activity. So we need to first pass an entry for that. We have to transfer the expenditure which is related to production from the administration overhead control account to the WIP control account. So let's pass the entry for transfer of 10,000 rupees worth of admin and office overheads to production activity. So the entry will be WIP control account debit rupees 10,000 to admin and office overhead control account rupees 10,000. Let's go to the WIP control account and post this entry. On the debit side, we will have to admin and office overhead control account rupees 10,000. And in the admin and office overhead control account, it will be on the credit side, which will say by WIP control account rupees 10,000. Now if we look at the WIP control account, on the debit side, we have direct material 80,000, direct wages 60,000, we have to production overheads absorb 45,000 and to administration overheads transferred rupees 10,000. The total of this is 1,95,000. And they are saying the cost of the finished goods produced is 1,95,000, which implies that there is no WIP lying as a closing stock. See, had they said that the cost of finished products is 180. So we would have transferred 180 from this account to the finished goods account, and the balance 15,000 would remain in the WIP control account, which would signify that there is some closing balance of work in progress. Let's pass an entry for transfer of 1,95,000 worth of goods from WIP control to the finished goods control account. So the entry will be finished goods control account debit 1,95,000 to work in progress control account 1,95,000. In the WIP control account, on the credit side, we will have an entry by finished goods control account 1,95,000, and with this your WIP control account is going to get closed. In the finished goods control account, on the debit side, we are going to have an entry to WIP control account 1,95,000. Now, next, they are saying that we have sold goods worth rupees 1,90,000 in the market. So first, let us make an entry for the transfer of goods, that is the finished goods, from the finished goods account to the cost of goods sold account. You can please go back to your cost sheet and refer the flow of the transactions. So we have the material, wages, the prime cost. To the prime cost, we added the production and admin overheads related to the production activity. We arrived at the cost of production. We adjusted for opening stock and closing stock. We arrived at the cost of goods sold. So this is what I am referring to. From the finished goods account, we are now going to transfer the cost of goods that we have sold to a separate account called the cost of goods sold account. What will be the entry? Now finished goods are going out, so we will credit the finished goods control account and we will debit the cost of goods sold account. So cost of goods sold account debit 1,90,000 to finished goods control account rupees 1,90,000. Now you may ask me, sir, in the finished goods control account, if we do this posting will come on the credit side and it will say by cost of goods sold 1,90,000. We are still having a balance of 5,000. What is this? This 5,000 is nothing but the cost of finished goods inventory. This will be the closing value of your finished goods inventory. Now let's do the posting in the cost of goods sold account. In the cost of goods sold account, on the debit side, we will have to finished goods control account rupees 1,90,000. Now going back to the cost sheet, what have we done next? We have added the admin overheads and selling and distribution overheads, and we have arrived at the cost of sales. So similarly, here also what we will do is we will transfer this cost of goods sold to a new account which is called as the cost of sales account, and in this cost of sales account we will also transfer the balance admin overheads and the selling and distribution overheads to arrive at the cost of sales. So first let's pass an entry for the transfer of goods from cost of goods sold account to the cost of sales. So cost of sales account debit 1,90,000 to cost of goods sold 1,90,000. If we go to the cost of goods sold account, on the credit side we will do this posting by cost of sales 1,90,000 and the account will get closed. Now in the cost of sales account, on the debit side, we will have to cost of goods sold 1,90,000. We will now transfer the admin overheads to this account, and we will also transfer the selling and distribution overheads to this account. Let's go to our admin and office overheads control account. Now in the admin and office overheads control account, on the debit side, we have 50,000 rupees total, and out of this 50,000, 10,000 we have already transferred to WIP because it was related to production. We still have a balancing figure of how much? 40,000. Let's pass an entry for transfer of this 40,000 to the cost of sales account. So cost of sales account debit 40,000 to admin and office overhead control account rupees 40,000, being transfer of admin overheads to cost of sales. So with this, if we post it in the admin and office overhead control account, the admin and office overhead control account gets squared off, gets nullified. Let's go to the cost of sales account. In the cost of sales account, on the debit side, we are going to have this as to admin and office overhead control account rupees 40,000. Also, let's transfer the selling and distribution expenses. Going to the sales and distribution overhead control account, we have on the debit side rupees 20,000. Let's transfer this to the cost of sales. So cost of sales account debit 20,000 to selling and distribution overheads control account rupees 20,000. The selling and distribution overheads account gets closed and nullified, and in the cost of sales we will write on the debit side to selling and distribution overheads 20,000. So with this, our total cost of sales is how much now? If I add up the debit side, 1,90,000 plus 40,000, that is 2,30,000 plus 20,000, 2,50,000. So 2,50,000 is the cost of sales, and this cost of sales we will now transfer it to the costing P&L. Let's make an entry for the transfer. So costing P&L account debit 2,50,000 to the cost of sales account 2,50,000. In the cost of sales, this will get posted on the credit side and the cost of sales account will get nullified. In the costing P&L, on the debit side, we will say to cost of sales 2,50,000. So if you now see the costing P&L account, on the debit side, we have two entries. One 5,000 rupees that came from the production overhead control account, which was the under absorbed overhead. Plus we have this 2,50,000 which has come from the cost of sales. The total cost becomes 2,55,000. If you go back to your cost sheet, your adjusted cost of sales was also rupees 2,55,000. Understand the linkage and the flow of how the cost records are going to be maintained. Alright. Now, they have said we have sold these goods for how much? We have sold these goods for 3 lakh rupees. Let us pass an entry for sales. Forget cost records for a moment. If this was a normal accounting and if it was financial accounting, what was the entry that we would have passed? We would have said cash account, bank account or debtor account debit to sales account 3 lakhs. But here, since it is not a transaction related to the cost of the goods or cost of the product or service, we are not going to pass such an entry. The entry that we are going to pass will be cost ledger control account debit 3 lakhs. We know that we have sold for 3 lakhs. Now whether we have received cash bank or we have to receive some money from debtor, all that we don't care. We are just saying cost ledger control account, a representative account debit 3 lakh to costing P&L rupees 3 lakh. So we are directly crediting the costing P&L statement. Now in the cost ledger control account, this entry will appear on the debit side. So the posting will be to costing P&L account rupees 3 lakhs, and in the costing P&L account on the credit side we are going to have a posting by cost control ledger account, that is sales rupees 3 lakhs. Now friends, let's balance the costing P&L. On the debit side we have 2,55,000 worth of expenditure and on the credit side we have sales worth of 3 lakhs. So if we balance it out, we are having a profit of how much? We are having a profit of rupees 45,000. Under the normal accounting system, we would have transferred this profit and loss account balance, the profit number carried forward. We would have transferred this, we would have carried it forward to the balance sheet, the capital account, or maybe if it is a partnership firm, the partners account. But here, we are not maintaining the balance sheet. Here, we are not maintaining the capital account. So what we will do is this profit entry, we will transfer to a representative account, which is our cost ledger control account. What will be the entry for transfer? We will say costing P&L account debit 45,000 to cost control ledger account 45,000. Let's do the respective posting in the costing P&L and in the cost ledger control account. With this posting in the costing P&L, the costing P&L account will get nullified in 0, and in the costing P&L account, it will appear on the credit side as by costing P&L rupees 45,000. Now let's bring all the ledger accounts into the play and see what are the balances remaining in each of the ledger accounts. First, the cost control ledger account. If I add up the debit side and the credit side, we are having a credit balance of rupees 15,000. Now this 15,000 will get carried forward to the next period. Alright, so we will say it is a closing balance which has to be carried forward and it will be brought down in the next period of rupees 15,000. The stores ledger control account. In the stores ledger control account on the debit side we have 1 lakh, and out of this 1 lakh on the credit side 80,000 was issued to production, so WIP control account. 10,000 was issued towards indirect material production related, so we still have a balance of how much? 10,000 rupees. This 10,000 is going to be the value of closing raw material. It is going to be the value of closing inventory. This will also get carried forward to the next period. So we will have a closing balance of 10,000 rupees. Then next, WIP control account. The WIP control account is nullified. and it is 0. The wage control account is nullified. Production overhead control account, admin overhead control account, selling and distribution overhead control account, all these accounts have been nullified. We have a balance of 5,000 rupees in the finished goods control account. This also is a closing balance. It is a closing value of inventory and will get carried forward to the next period. Then the cost of sales account, cost of goods sold account, costing P&L account, all of these are also nullified. So we have only 3 accounts now with closing balances. One, we have the cost ledger control account, which has a credit balance of rupees 15,000. We have the store ledger control account or the material control account with a balance of 10,000, and we have the finished goods ledger account with a balance of rupees 5,000. If we draw up the trial balance, if we say let's prepare the costing trial balance, it would appear something like this. On the debit side, we will have raw material value, that is the stores ledger control account debit balance of 10,000, finished goods control account balance of 5,000 on the debit side, and cost ledger control account 15,000 credit balance. Overall the trial balance will get tallied. So this is how the entire cost records are going to be maintained.